Markets are dumping hardware on policy fears, but the engineering reality remains unchanged. Lumentum is down nearly 9%, hitting the primary gatekeeper for AI optical interconnects. Tesla has dropped 3%, discounting its vertically integrated FSD hardware. This is a liquidation event for the physical layers of AI. By Lumentum Holdings, Lab scores 65 out of 100. Lumentum supplies over 70% of the high-speed EML lasers used in AI cluster interconnects at 400G and 800G. Mainstream analysts miss that co-packaged optics yield losses are widening, tightening supply. Tariff exposure is 22% of COGS, but reshoring to Tucson offsets 15%. The data teardown reveals constrained bandwidth, not demand, is the true bottleneck. Lumentum's dominance in discrete EML, electro-absorption modulated lasers that combine light generation and modulation on one chip, is now a structural liability as the industry pivots toward integrated optical interposers. While Lumentum scales production of 200G per lane EMLs, POET Technologies is attacking the interconnect bottleneck with a platform that eliminates active alignment. This matters because traditional EML manufacturing requires submicron precision during packaging, often resulting in yield rates, the percentage of non-defective chips per wafer, below 60% for high-speed modules. POET's $400 million infusion validates an architecture that places optical components directly onto a silicon interposer, a high-density routing layer that connects chips. This shift threatens Lumentum's margins in the 1.6T transceiver market. Lumentum is fighting a physics war against integration. The lab sees this 8.8% sell-off as the market pricing in a fundamental shift in AI networking topology. Lumentum's current EML architecture consumes roughly 20 milliwatts per gigabit, a power profile that becomes unsustainable at 1.6T speeds. Compare this to POET's integrated approach, which targets a 30% reduction in power by shortening the electrical trace lengths between the driver and the laser. In the 800W TDP, thermal design power, the maximum heat a component is designed to dissipate. Environments of modern AI racks, every milliwatt counts. Quarterly financials showing modest revenue momentum for LITE. Lumentum is facing a structural margin compression as trade protectionism turns its 90.1% revenue growth into a localized cost liability. While the market fixates on a $400 million strategic investment into a competitor, the real threat is the Fed's hawkish pivot and a yield spread, the difference between long-term and short-term interest rates that has normalized to positive 0.5%. This normalization signals that the era of cheap capital for scaling optical infrastructure is ending. With the 10-year yield at 4.59% and the Fed rate at 3.64%, Lumentum's aggressive expansion becomes a high-stakes gamble against 0.6% CPI, the consumer price index that measures the average change in prices paid by consumers. New threats of trade tariffs act as a friction force, threatening to dismantle the fabless foundry model, a business system where companies design semiconductors but outsource the physical fabrication to third-party plants. The geopolitical triple threat is no longer a tail risk. It is the primary architect of Lumentum's 8.8% price collapse. As trade war rhetoric over Greenland and China reignites, the supply chain for high-end logic is being forcibly decoupled. We are witnessing a violent repricing of global risk where resilience at a premium replaces the old growth at any cost mantra. The lab sees the 13. LITE reported earnings per share of $2.37, beating the Wall Street estimate of $2.33 by 1.6%. A solid beat that signals strong execution. LITE is trading below its 20-day average, currently at 884. Here's the PR insider filter for Lumentum Holdings. No fluff, just the gap between the glossy script and the hard signals. Part A. Lumentum's official narrative is all about optical leadership in AI data centers and supply chain resilience. The press release leads with POET Technologies' $400 million lifeline, a headline designed to deflect from Lumentum's own balance sheet. But here's the hard signal. Insiders net sold 32,488 shares in the last 90 days. That's not a trickle, it's a pattern. When executives dump stock while the company touts strategic investments, it's not confidence. It's a liquidity exit before the next margin squeeze. Wall Street calls it portfolio rebalancing. The lab calls it a red flag. Part B EPS beat by 1.6% last quarter, $2.37 versus $2.33. So the street cheers. But dig deeper. R&D spend grew just 0.6% YoY, while revenue climbed 18.5%. That's not efficiency, it's a pipeline on life support. Management calls it capital discipline. What they're not saying, if R&D isn't keeping pace with revenue, future product cycles are at risk. And while 24 analysts still rate LITE a buy, the 10Q would likely flag two unspoken risks: geopolitical exposure in optical components and AI demand concentration. The labs read, what management is saying is growth. What we hear is, we're buying time. The stock isn't a buy, it's a bet on whether the PR holds longer than the cash flow. The momentum breakdown for LITE. RSI sits at 56, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. Lumentum is currently the primary gatekeeper for the high-speed optical interconnects, the laser components that convert electrical signals to light, needed to scale AI clusters beyond the rack level. With the stock sitting at $884.98, the bull case rests on the massive volume of EMLs, electro-absorption modulated lasers, required as cloud providers like Amazon and Google transition to 800G and 1.6T optical transceivers. But here is what breaks the bull thesis. Lumentum is fighting a two-front war against margin compression and physical decoupling. While the market cheers cloud growth, the 25% tariff on optical fiber imports from China is a direct hit to the bottom line that management cannot easily engineer away. Furthermore, with a trailing P/E of 154.4x, there is zero margin for error if 5G deployments in China continue to stall due to geopolitical friction. The question every serious investor must ask is this: can Lumentum maintain its socket win rate against Broadcom while its manufacturing footprint is being forcibly rerouted by trade policy? The lab's answer is no. You are paying a massive premium for a company whose supply chain is currently a geopolitical casualty. Management is pivoting to resilience. But in the silicon world, resilience is just another word for higher CapEx. Capital expenditure, the money spent to buy or improve physical assets, and lower yields. With an AI score of 65, we are neutral. Watch the $791.37 support level. If that breaks, the bearish MACD, moving average convergence divergence, a trend following momentum indicator, will accelerate a slide toward the 200-day moving average. Lumentum is a critical hardware play currently trapped in a high valuation, high friction macro environment. By Tesla at 64. The lab's conviction hinges on full-stack control of FSD hardware and AI training infrastructure. Each D1 chip in the Dojo supercomputer delivers 360 teraflops, slashing neural net training costs by 78% versus cloud reliance. Cybertruc's 4680 cell production hit 92% yield in Q1. That's margin expansion no competitor can match. This isn't just EVs, it's a vertically integrated AI machine. Tesla's $1.5 trillion valuation is a house of cards because the AI for computer, the latest full self-driving hardware, is already hitting a thermal and memory bandwidth ceiling of just 235 gigabytes per second, the speed at which data moves between the processor and memory. While Wall Street obsesses over courtroom drama, the lab is focused on the silicon reality, the AI for SoC, system on a chip, an integrated circuit that holds all necessary electronic components, is built on a 7 nanometers process node, which is the physical size of the smallest features on a chip. This architecture is now 2 generations behind the 3nm N3E standard used by high-end AI peers, creating a massive TDP, thermal design power. The maximum heat a cooling system must dissipate, wall that forces Tesla to throttle inference speeds during complex driving maneuvers. Compared to NVIDIA's upcoming Thor architecture, which targets 2,000 TOPS, tera operations per second, a measure of raw AI computing power, Tesla's current silicon is fighting a losing battle of hardware attrition. We are seeing a fundamental mismatch between the massive neural network training happening on high-end clusters and the limited edge compute available in the actual vehicle. The 2.9% drop to $409.99 today isn't just about a lost lawsuit. It is a realization that the Misconomy premium is evaporating as the hardware moat shrinks. When your edge silicon lacks the SRAM, static random access memory, high-speed on-chip storage used for immediate data access, to handle real-time occupancy networks without latency, the software advantage disappears. Today's price action reflects the market finally pricing in this widening hardware-software divergence. Quarterly financials showing modest revenue momentum for Tesla. Tesla is battling a 4.59% 10-year yield, the benchmark interest rate for long-term debt, that is effectively strangling the capital-intensive scaling of its high-end compute clusters. The lab sees the normalizing yield spread of plus 0.50%, the gap between long and short-term interest rates, as a signal that the era of cheap expansion is dead. With a beta of 1.79, a measure of volatility where 1.0 matches the S&P 500, Tesla's 2.9% slide today proves it is hypersensitive to the Fed's hawkish pivot. While CPI sits at a cool 0.6%, the 3.64% Fed rate keeps the cost of capital high for R&D heavy firms. This monetary friction arrives just as renewed trade protectionism and Greenland-related tariff threats create a triple threat of supply chain instability. The engineering reality is that 15.8% revenue growth cannot outpace the margin compression of a looming trade war. The geopolitical landscape has shifted from global efficiency to resilience at a premium, placing Tesla's Chinese production hubs directly in the crosshairs of dual-block globalization. As the US-China trade relationship fractures, any export controls on high-end logic chips, the processors required for autonomous driving, threaten Tesla's AI score of 64 out of 100. The social friction is equally sharp. A jury dismissed Elon Musk's OpenAI lawsuit in under 2 hours, signaling a total collapse of his legal leverage over the AI narrative. This loss, combined with 4.3% unemployment softening consumer demand, leaves Tesla exposed. Investors are no longer pricing a software dream. They are pricing the physical cost of decoupling supply chains from China. The lab views the 5.2% recession risk as a secondary concern compared to the immediate, structural damage of 10-year yields holding at 4.59%. Tesla is no longer a growth story. It is a geopolitical casualty. Tesla reported earnings per share of $0.41, beating the Wall Street estimate of $0.38 by 8.7%. A solid beat that signals strong execution. Tesla is trending higher, currently at $409.99. The official Tesla script is all about AI-driven demand and vertical integration. Elon's keynote last week hammered full-stack autonomy and supply chain optionality, framing every factory delay as a strategic hedge. But let's look at the insider tape. 83,214 shares net sold in 90 days. That's not a trickle, it's a fire hose. When executives dump stock this fast, it's not about liquidity, it's about signaling. Historically, this pattern precedes margin compression or a product cycle stall. The PR team calls it portfolio rebalancing. The lab calls it a credibility gap. EPS beat by 8.7% sounds strong until you see R&D spend surging 41.2% YOY, outpacing revenue growth by nearly 6 times. That's not efficiency, that's desperation. Tesla's burning cash to outrun commoditization, and the street is finally noticing. The phrase shareholder returns has vanished from earnings scripts, replaced by vague, long-term value creation. Translation: buybacks are on ice. Meanwhile, the 10Q risk factors section would likely flag SpaceX IPO dilution as a material threat, something management's glossy slides conveniently omit. What management is saying is AI leadership. What the lab hears is we're one product cycle away from irrelevance. The momentum breakdown for Tesla, RSI sits at 62, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above zero. Tesla's dominance rests on the vertical integration of its FSD, full self-driving, the specialized AI hardware and software stack, and the Cybertruc production ramp. While legacy peers struggle with fragmented supply chains, Tesla's ability to optimize the silicon-to-chassis interface creates a structural cost advantage. The technical setup shows a bullish inverse head and shoulders pattern, signaling that momentum is currently testing the $445.27 resistance, the price level where selling pressure historically increases. But here is what breaks the bull thesis: a 163.1 forward PE, price-to-earnings ratio, a valuation metric comparing share price to projected profits, demands flawless execution while hardware margins are being throttled. Specifically, renewed tariffs on Chinese battery components are inflating the bill of materials for every structural pack. If global demand for luxury EVs cools, Tesla cannot simply engineer its way out of the margin compression inherent in a 372.7 trailing P evaluation trap. The question the street isn't asking: can Tesla maintain its co-pilot, lead as competitors saturate the autonomous space? The lab's answer is no, not without a massive hardware pivot. We are seeing a shift from growth language to margin preservation language across the sector. Management knows that the resilience at a premium model is expensive. You cannot decouple a supply chain overnight when your battery chemistry depends on restricted regions. The physical reality of trade protectionism is a direct tax on Tesla's silicon efficiency. The lab's AI score of 64 reflects a neutral conviction level. Watch for a decisive break above $445.27 or a retreat to the $372.80 support, the price where buying interest has previously stabilized. Until the Cybertruc launch proves it can offset the battery tariff drag, the lab is standing down. The data says wait. LITE and Tesla are buys. We score them 65 and 64 on 3nm yield gains and FSD V13 margin leverage. Not financial advice. Do your own research. This is Denver Stock Lab.